Global economic trends are often measured in thousands of tons of cargo, yet the impact is felt at the local level. A disrupted shipping lane a hemisphere away can determine if a small business remains viable. When the International Monetary Fund lowers its global growth estimate to 3%, the data point feels distant. However, that shift alters the calculus for household financial planning and local business margins. Macroeconomic shocks travel into local profit and loss statements through a predictable chain of events. This split-screen diagram tracks the transmission mechanism. On the left are macro variables like IMF growth estimates. On the right are micro decisions at storefronts and household budgets. A disruption activates this pipeline, turning abstract percentages into operational realities. We can trace this flow across 4 specific pillars: trade, energy, credit, and technology capital expenditure. Understanding this transmission mechanism allows a local operator to anticipate shifts in the modern global economy rather than simply reacting to them. International commerce relies on massive maritime transit hubs, where millions of units of inventory are processed on strict, thin-margin schedules. When physical bottlenecks emerge along key corridors, shipping volume is restricted, and carriers increase rates to compensate for elevated transit risks. This geographic map illustrates those bottlenecks. Red zones in the Strait of Hormuz represent transit blockages that choke the global supply chain. For a local retailer, this macro blockage translates into delayed inventory and higher freight premiums that compress profit margins. Policy shifts compound these physical blockages. The United States has implemented enhanced border tariffs, eliminating duty-free tax exemptions for low-value cross-border e-commerce shipments. This flowchart shows a compounding cost multiplier effect. Losing the tax exemption alters cross-border logistics, moving downward until it hits the local retail warehouse. Without the duty-free threshold, online retailers must either absorb the tax or overhaul their pricing models to pass the cost to the consumer. Small business margin compression is often the mathematical output of these trade frictions, tariffs, and maritime disruptions, flowing to the bottom line. Industrial output is dependent on the availability and pricing of fuel. This timeline graph tracks price fluctuations in crude oil and natural gas benchmarks, which react immediately to trade bottlenecks. Natural gas is the primary feedstock for fertilizer. A secondary, delayed curve shows how fertilizer production and freight costs trail the natural gas spikes. These chemical and logistical costs are transmitted to the agricultural sector, raising the input expenses required to grow crops. Unpredictable weather in major agricultural regions further compounds this by tightening the supply outlook for staple grains. Ultimately, the endpoint for this entire supply chain is the consumer shopping environment. Energy spikes and grain shortages combine to create cost-push inflation, forcing consumer prices upward. At the micro level, households face higher utility bills and a percentage increase in grocery shelf prices. A severe household budget deficit is frequently the localized manifestation of a bottleneck in an overseas energy corridor. Central banking authorities, such as the United States Federal Reserve, set the global cost of capital. Currently, the Federal Reserve and the European Central Bank are holding benchmark interest rates steady. Rates remain steady because core inflation is sticky, driven by service sector wage growth and the volatile energy transport costs we've tracked. These dials represent locked benchmark interest rates. Below them are 3 channels affecting the economy. First, high rates flow into consumer mortgages, bottlenecking housing market activity. Second, in corporate refinancing, high borrowing costs make rolling over debt expensive. Facing these hurdles, local businesses delay hiring and capital expansion. Third, the sovereign debt pipeline shows a pressure buildup as developing nations face heavy debt burdens that squeeze public budgets. This pressure forces emerging economies into debt restructuring to maintain vital social programs. A paused dial at a central bank affects local home purchases, job creation, and infrastructure development. The rapid acceleration of specialized computing hardware is a significant macroeconomic disruptor. Technology conglomerates like Amazon, Alphabet, and Microsoft have projected multi-hundred-billion-dollar capital expenditure budgets for 2026. This bubble chart compares those budgets for AI data centers against traditional economic sectors. While AI is a digital product, it relies on physical facilities that consume power at levels requiring direct private equity investment into regional electricity infrastructure. An energy grid map reveals the consequence, as grid-constraint hotspots bloom around these data center clusters. These power constraints drastically increase local utility pricing, limiting the available electrical power required to keep traditional industrial manufacturing facilities running at full capacity. Companies are also scaling up cybersecurity expenditures to mitigate breaches by autonomous software. The boom in artificial intelligence reallocates electricity and corporate budgets away from traditional operations. Financial strategy requires calculating how these variables intersect. Macroeconomic policies and trade bottlenecks function as direct input variables for local operating costs. Our completed transmission model shows how trade, energy, credit, and technology forces interact. To mitigate shocks, corporations redirect investment to Latin American production hubs, shortening delivery distances. In real estate, high vacancy rates mean developers pivot commercial office properties towards residential conversions. Households most plan budgets to absorb persistent borrowing costs and local inflation over the long term. General wage growth is cooling as labor markets return to pre-expansion averages. However, with high-performance computing hardware aggressively driving the manufacturing sector forward, global hiring demand remains heavily concentrated in highly specialized technical roles. Analyzing global indicators is not an academic exercise. Tracking the transmission mechanism is a requirement for local survival.